Yeah, it's a great question, Wolf. I think that's always a difficult question to ask and trying to figure out where the bottom is and, where markets are. So what I would say, though, is the market has been trying to find that bottom. Obviously, it was a very difficult January. It's been a tough tape all month. Had some really nice days the last 2 days, and NASDAQ up 3% today. But what I would say is, listen, the Fed has embraced a hawkish tone. There have been some folks I think were caught off sides in the early part of January have now really looked to position and look at their shopping list and trying to figure out where ultimately they need to be. We've been talking about this for a long time in terms of, the high beta non-profitable names are going to struggle in this marketplace, whether the Fed raise 4 or 5 times, 3 times. We understand where we need to be in more of the value-oriented sectors, but it does create some opportunity and growth, and I think that's what we've seen over the last 2 days. So let's see how the rest of the quarters play out and the rest of the earnings season, which I think will be strong from here on out.
Well, on that subject, on the Fed, we did talk last hour to Richmond Fed President Thomas Barkin. We asked about recent market volatility and whether that will influence Fed policy. Listen.
Our mandate is very clear on unemployment and inflation. We also play an important role in financial stability through our oversight of the banking system. And so I would see everything through that lens. And if something started to affect financial stability, that's something to pay attention to. But I don't think I'd pay attention to the stock market per se.
We also asked him about his expectation for this Friday's January jobs report.
I'm not expecting a very strong pay report for the same point I just made a couple minutes ago, which is there were a lot of people on the sidelines in the second week of January because that really was, I think we're going to figure out the peak of this latest variant. And so that's a temporary thing. I don't have a problem seeing through temporary things. Everything I hear from employers is that demand is extremely strong. That's personal balance sheets.
Mike, my takeaway, we threw everything at him, the market downturn, the fact that the data's turned weaker, the fact that we're expecting a bad jobs report, which he is as well in January. They are focused on inflation now. He says that's what's going to guide us on our rate hike policy and our path. And they're playing down any economic weakness or job market weakness. Not that we're necessarily seeing that more than a temporary Omicron hit, but they're fully focused on inflation.
Yeah.
So if you were looking for this Fed to blink or get worried, for instance, about the market or the economy, they're just not there yet.
No. And first of all, I don't think 10% down in 4 weeks would ever necessarily move the Fed off of any plan. But I agree that they're checking off the box and says the labor market is kind of, for the moment, mission accomplished. I like what Barkin said about how it's on an interim basis, we're at full employment. We may be able to get things better after we're totally through pandemic effects. But right now, it's full employment. So the main job of the Fed is to, rebuild some of its ammo to fight inflation. And that seems to be where they are. They don't want to be very specific about guidance. They're not particularly interested in being all that predictable as they were in past times when they thought the economy was a little bit more fragile. I mean, look, housing's in a good spot. You have a CapEx cycle that should start right now, corporate profitability, credit conditions, everything that they would worry about as opposed to the stock market is looking okay for them.
Jason, given that we've seen so many upgrades from various Wall Street banks in terms of the number of hikes they expect in the year ahead over the last week or so, does that mean when the hikes actually come, we won't see the market react to the downside?
Yeah, so that's another good question. I would say that most of the response you see early on, right? So when we really are starting to move towards this cycle, a tightening cycle, that's when we see a lot of the volatility. Once it starts, some of that volatility will slow. But ultimately, as Mike said, I mean, the Fed will be data dependent. They are reliant on, CPI and the prints and the PCI and PCE, I should say, and what that looks like going forward. But I do think there's likely more volatility ahead, as they start to move rates starting in March. So we'll see how things unravel over the next few months.